This season has been very confusing. You know, the corona pandemic has caused us to rethink so many things. One of the things that has been so confusing for so many ones of us has been, how do I invest? What do I invest in? Where should I keep my money for those of us who still have an income coming through? And so I have with me Kenneth Kaniu, who's the CEO of Britam Asset Managers, who's going to answer all my questions around what should we be investing in this season. Thank you, Ken, for agreeing to have this conversation with me.
That's right.
And, you know, I'm just wondering, a lot of the messages I've been getting is around, you know, I have a little bit of money, but I'd rather have it in a bank account where I know next week when I go, I will find the cash that I put in, and maybe just a little bit on top, but maybe perhaps not much at all, but I know that I'm not going to lose my capital.
That's right.
And so in this season, I'm finding a lot of people are putting their money in cash. What's your view on that?
Okay. I think my overall sense is that, firstly, the pandemic is going to have to pass. That's the first thing.
Yeah.
It has started and it has to end at some point. So it's really the decisions that you take now that will determine how you then look like at the end of the pandemic. So invest through the cycle. That's what we usually say.
Invest through the cycle.
Throughout. You should never stop.
You know, we have a tendency of wait. I want to time it.
Right.
So that when it's really bad, then I get in.
That's right. You can certainly time things as an individual, and sometimes as an individual you get it wrong. But if you time things having benefited from some professional advice, it then works.
Okay.
So as an example, we all have seen the stock market has done very badly this year off the back of the pandemic you've spoken about.
Right.
The market is down by maybe 20 or 30%, which is horrible. So there are people who have lost money. But remember, the way stocks work, you're supposed to buy low and sell when it's high. So guess what? Now it is low.
So we should be buying.
So truly, if you are interested in investments and you're going to be here in another 5 or 10 years, now is the time to buy these companies.
So you just keep buying slowly over time?
Because if you look, absolutely. Because if you do look at the banks, the share prices are down by 40–50%.
Yeah.
That doesn't mean the banks are collapsing. In fact, many of them are still doing fairly well, with the exception of the last set of results that we saw a couple of weeks ago. So you're supposed to remember, you buy low and sell high. So now that it is low, you're supposed to do something. And that is why I then said you will benefit from the actions you take now will determine how you look like 1 or 2 years from now. Because 1 or 2 years from now, when you finally want to buy those shares, and they are now up by 100%, and that's the time you feel I should now get in, you'll then remember, you know, a year ago in the pandemic, they were down by 50. I should have bought then.
That would have been the last. I can't buy now.
Yeah, you can't buy now. So you will now be thinking then about hindsight and wishing you took the decision now. So guess what? Now is the time to be able to take such a decision, if indeed stocks and equities is what you want. Obviously, cash is good. And it is good to have cash. And I think for those who have cash, then they are certainly in a good position. But remember, cash doesn't grow by itself.
No.
In fact, inflation is like a weevil. It really erodes the purchasing power of your money. So every year when you go to, sometimes even every quarter, you go to the supermarket, things have gone up. Price of milk and bread and fuel. I think fuel is a great indicator. Every month we are waiting from the email or the message from the ERC telling us what is the new price of fuel. These things keep on going up.
Yeah.
So if these things are going up faster than the rate of growth in your cash, then you are losing. So you need to be able to do something useful with your money even now. So you need to be able to sit down and tell yourself that earning zero in the bank is not good. You need to be able to come to terms with that. Your money is in a current account. You have 2,000, 50,000, 100,000, 1 million in a current account. It's earning zero. So you need to ask yourself, is that really good? And is that really the most reasonable way of dealing with this money? Because you're still being charged bank charges. You're still being charged, is it 30 or 40 or 50 shillings at the ATM?
Yeah.
Every time you go on mobile banking just to check at midnight, do I still have the money? You have lost the money. The bank is making money, no wonder they report billions in profits. So you need to ask yourself, is zero really what I want? You may also be told by the bank, we'll give you 2%. because you're a good customer. But is 2% good? You need to ask yourself that. Can you do more than 2%? I mean, surely, most likely you can.
Yeah.
You need to look at something like a treasury bill, a 90-day treasury bill. This thing will pay you 7%, tax-free. So why are you not in something like that? You can keep on rolling over the money. I think that kind of makes sense. Or go into that 6-month treasury bill or a 1-year treasury bill. Explore. Go and tell everybody, I'm now in treasury bills. It's much better than saying I'm now in a
bank
current account. At least with the treasury bill, not only do you look a bit sophisticated, but actually it is sophisticated because you are better than someone who's just in a current account. You are now earning 7, 8, 9, 10% tax-free. You'd rather be doing that as you then start to think through what else you can do with your money. Don't also put all the eggs in one basket. Still have some money in the current account. That is okay. Still have some money in these T-bills. See how they are going. And also invest some money in those stocks so that when you are now buying low and selling high a year from now, 2 years from now, the guys will say, wow, you've done quite well.
Yeah.
That doesn't solve the problem of someone who bought equities a year ago.
So that's the thing, yeah. So if somebody bought even 2-3 years ago, perhaps bought Centum at 60, bought Equity Bank at 62 and KCB at 53, and they're looking at you wondering, listen, my friend, I am in serious losses, so what should I be doing now?
That's a tricky one. What I typically say is, number one, you can take 2 decisions. So the first decision is that you pull out and you realize your loss.
Okay.
Remember, for now it's a paper loss. You bought it at 60 bob, as you say. Maybe now it's come down to 30. But it's not a real loss because it can also recover and go back to 60 and so on and so forth. It will become a loss the day you actually pull out the money. So the first option that you can take is to pull out the money and you go off and do something else. The other thing that you can do is reevaluate your take on Centum. If you believe Centum is a good company and you bought it at 60, surely even 30 is good. Perhaps you should buy slightly more so that you then bring down your price from 60 to 40 or something like that. That might also make a bit of sense. But what we certainly hope is that as you made your decision, you had gone through some, let me say, reasonable process in determining that Centum is a good company. And here we are talking about it for purposes of discussion. It could be any company really that we are talking about. But if you go through a process and you evaluate it is in fact a good company, that's why you bought it at 60, then it means at 30 this should be a really good purchase, isn't it? So perhaps you should consider putting in some more. There are some people who don't go through a reasonable decision-making process when they buy shares. You heard my story at the start when I was younger. So it's normal. Maybe you buy shares out of emotion, or you buy shares because everybody's buying, or you think it looks good, or you really believe in the management team, but you may not have a good understanding of the mechanics. There are those who possibly will not recover. And we also have to be able to come to terms with that and recognize, just like I did some years back, it's also possible that you just made the wrong investment in the wrong company. So it does happen as well. So I'd say to those people, don't let that completely dampen your spirits. Because remember, when you go through an investment journey, and it's a journey, some things have to go right and some things have to go wrong. But what we're supposed to do is minimize those which are wrong and have a better success rate with those things which are working well. So hopefully you've gone through that, you have some professional advice, you have diversified, as I said earlier. So I'd never advise anybody to put the school fees into shares. That's not how it works. Here we're laughing, we say, of course, but that is what happens on the ground. So I would never advise anyone to put everything in the stocks.
Not only school fees. I mean, we've had situations where people even borrow.
That's right.
To put in the stock market.
Absolutely.
To invest,
what you need to do is maintain the current account, have that money in the T-bills, and then for what you think that you are not going to need for 1 year or 3 years or 5 years, that's what you should put in the stock market. Because it's not Russian roulette, as an example. There are many other things one can do beyond the cash, the treasury bills, and the stocks. One can also consider real estate. And the good thing with real estate now is that the prices are either moving sideways or beginning to come down. So once again, you buy low and sell high. There's certainly an opportunity now. There are a lot of people who unfortunately are facing financial distress and pressure. And that creates the need for them to liquidate their assets and create a good entry multiple for you as a buyer. So that's something that you can consider. We are telling a lot of people to slow down on what I'd call actual investment, where you not just buy land but develop it.
Yes.
Because if you develop a retail mall today, and or a commercial office building today, and you deliver it into the market today, you struggle to get tenants, because you see we're in the middle of not just a public health crisis, but an economic crisis as well. It's really dented people's ability to be financially secure.
Yeah.
And that money is in the bank account. It's not going to be spent on fitting out a new office and so on and so forth. I mean, where's the business?
There's no business.
So you'd rather than buy the land now, you buy low, because land is a very important component in real estate development. But if you can deliver this building or whatever it is in 2023 or 2024, then you have some better prospects of doing well, because we do think that surely by then the economy should have recovered and gotten back to normal, let me call it normal trading levels.
So you don't think that the office as we know it, and just the way that we do work as we have been, is going to change?
My sense is that it will.
Okay.
For us at Britam Asset Managers, 90% of our staff work from home. 90, and they've been working that way from March. We are fortunate because we had made the investments into IT ahead of time, not in anticipation of the pandemic, but because it was the right thing to do. So now people are at home, they have laptops, they are internet enabled, they can connect remotely to our systems, and they're able to work. In fact, we have realized, particularly in the area of things like operations, finance, higher levels of productivity than were there in the office, which is very, very interesting. So we're beginning to then wonder, how are we going to get people then to come back? We did a little survey the other day, and most people say, I think we should just stay home.
So what do you do with your nice swanky offices?
Yeah, so I think the bad news for them is that they will come back when we are done with the pandemic.
Okay.
Because that is the way it was designed.
Yeah.
But there are some things which have been done as a result of the pandemic, which may never return to normal levels. So as an example, how we organize ourselves, our structure, some of our processes, we change them as a result of the pandemic to get more simple and so on and so forth. We may never change that because it seems to work. So those are the kinds of things that may remain. It may not be unheard of to hear someone say, today I'm working from home. Can you please allow me to do that? Because there's something I'm doing. We probably will be more amenable to such requests going forward. So I think you will start to see a change in the environment. We are now big on virtual meetings. Initially, if you joined a meeting virtually, it was seen as a sign of disrespect to the other party. You can't even take the effort to come. Me, I'm here. Why have you not then come from wherever it is that you are? There are some people who will continue to want to have virtual meetings as opposed to physical meetings, which I think is fine. But ultimately, I think it will boil down to the views of the different individual leaders in all the different companies and entities and so on. If you have a leader whose view is, I need to see people in the office, everybody needs to come physically, then that is what is going to happen. Yeah. And I want to see people clocking in and out. So as soon as the pandemic lifts, that will be the methodology. There are some leaders who will take a different view and say the focus is on output, not clocking in and clocking out. So those are likely to continue to allow people to work from home. Not fully, of course, but if someone says, I want to work a 4-day week, you may start to hear that become not so extreme as it was prior to the pandemic.
Yeah.
For someone to tell you, I want to work 1 day at home, you look at him and wonder, is that normal?
Yeah.
But now, with the focus having switched to output, I think it'll change the way of work positively. But it depends on the individual company and board and organization and all that. It depends on the DNA and culture.
Yeah.
Some will just go back to pre-pandemic. Others will be on the other end where truly, let's close the office and let's work from home. It seems to work. And we'll be meeting in Java for the board meeting or the departmental meeting or whatever. It depends on the individual company.
I suppose so. And I guess in investing in real estate, you really have to be careful what kind of real estate space you're going to look for.
Absolutely.
Because you want to make sure it's something that is going to continue to be in demand.
That's right.
As time goes, because then you can end up with this beautiful building with nothing.
Absolutely. I have spoken to many CEOs of PR firms, advertising companies, who now are not going to take the same size of office space that they had prior to the pandemic. If they had 10,000 square feet, I think they have realized now that people are able to work from home.
Right.
They can create and come up with their output. You present it virtually over a Zoom meeting and we accept. We then take it to the client, again through a Zoom meeting or Teams or whatever, and it's accepted. So why do we have a 10,000 square foot office? So for many of them, they have cut the size of the office in half unilaterally. They are no longer renewing their leases. So that's what I'm seeing with media, PR, advertising firms. And I think that will continue to be the trend even post the pandemic, because now they are saving on fixed costs. The output is still being delivered, by the way, so I think it's fine. So that as an example will be a sector which may no longer favor real estate developers. But many of the sectors will continue to do so. If you're looking at doctors, lawyers, whatever, all of those rely on the physical engagement. The doctor has to finally see you at the end of the day. The lawyer has to finally engage you at the end of the day. In as much as they are, carrying out their cases and so on and so forth virtually, at the end of the day, you still, as a lawyer, need to convince the judge. It's not going to happen if half of the meeting is spent on, can you hear me, and are you still there, and so on and so forth.
And mute.
And mute. So that would work. So there are going to be people who will want to do that.
Yeah.
The supermarkets, I know we are now shopping online and so on, which is great. But sometimes the purpose of shopping in a supermarket is not just buying the stuff. Sometimes the purpose is to get out of the house. And I just want to go and sit in a supermarket and walk for 1 hour. So you can't run away from that. So truly that will continue to be something that takes off.
Okay.
Bank branches, we all hate them, but some point you need to visit your bank branch. So I think the scales are tilted in favor of real estate developers, but now they need to be more keen and do a bit more research, be a bit more sophisticated. Don't just build a mall and think people will come and say half of it is media. They're not going to come. Yeah, they won't bother. So you need to spend a bit more time.
So one of the things is I find people want returns.
Yeah.
A lot of people feel the returns that we get in financial sort of assets, stocks, bonds, money market funds, are so low. They're like 7% in a T-bill or, 9-10%. That's so little. And I'm reminded of, 2006 and a few years after that where we had an influx of pyramid schemes coming in. I remember seeing people losing such huge amounts of money. I mean, a couple raising $1 billion shillings within such a short period of time, promising huge returns, doubling money. I'll give you 10% per month, type of thing. So just quickly help us understand when an investment opportunity comes your way, because there are all kinds. What are some of the key things you need to look at as you evaluate that opportunity?
Okay. I think it's important to obviously have the right perspective as you do these things, because in Kenya, we are talking as an example of a treasury bill giving you 10% return, right? If you look at the West as an example, the guys are only getting 1% from these T-bills and so on and so forth. So the key thing here is that the treasury bill market, stock market and all that is not what is going to make you wealthy, because those are passive investments. They are going to allow your money to work, they'll allow your money to grow, but they in themselves don't make money. That's why they are called passive. So you need to get into an activity which is active, that can actually get and generate and make money. So the activity which is active, which a lot of people have perfected in the West, is through business.
Yeah.
You start a business and make some money first. Go and make some 10 million or 20 million. Then you can put it into the stock market and say that you have something that is working well, or put it into a T-bill so that you can make money. Because remember, there's a massive difference between 10% of 20,000 and 10% of 2 million. Those are very different concepts. And the higher up you go in terms of money, that 10% becomes very good. Because 10% of 20 million is a big number. Not the same as 10% of 100,000. And you'll cry, 10% of 100,000, what am I really doing?
I remember even with Emma Kiba, the government gave an opportunity for 3,000. With 3,000 shillings, you get 10%, and 10% tax-free.
That's right. And for a lot of people, they're like, why would 3,000, 10%, that's 300 bob. Is that even an investment, But for someone who invested 30 million, he's happy. He's gotten his 3 million. He went and bought a new car. In fact, he's very excited. So one has to get, and I don't want to give the wrong impression or the wrong image or whatever it is, but one has to get into an environment where you can take your 100,000 and actively invest it, not passively. So with that 100,000, go and start a business. or go and do some trading. You know, do something that will get you 100,000 to 1 million. Now that requires a lot of time and effort and thought, which we all struggle with, me included. It takes a lot of effort to start a business.
It does.
Businesses take time to succeed. They don't take 6 months or 1 year, they take 5 to 10 years. But once you're done with the 5 to 10 years, surely by then, if the business is alive, and many businesses don't work, but for the ones that are alive, they will have grown. And they will now be able to finance what I would call some active or some reasonable passive investments. But we don't seem to want to create new businesses in Kenya. The rate of job creation, the rate of business creation is low. We tend to want to just be traders. I'm going to buy from China and come and sell here, and you make the money for 1 year, then the whole thing then doesn't work. So create a business, which is what the guys have perfected in the West. And what they do, they create those businesses and then they sell us whatever they produce. So the way the world is organized, they are the producers and we are the consumers, which is not good. Okay, it's good to consume, but you should also produce and sell something to somebody so that you also get some money. And you make a margin and you all of a sudden you realize you're a business owner, you have become a bit wealthy and so on and so forth. So that to me is the reason why 10% is not a bad return. For a lot of people with 100,000, they may not have taken the time or effort and whatever to reflect on what can I do truly with 100,000. 10% for 100,000, if you're getting 10,000 bob a year, I agree, may not be the best. And that is how we have a lot of Kenyans getting lured. You are then lured into a scheme. And you are lured into a scheme that tells you in 6 months, we will turn your 100,000 into 250,000. So someone says, yeah, I think that sounds good.
Yeah.
And that is where they are going to take the money. And maybe it'll work the first or second time, but you know how these things work. I had you to give the example of the DESI. And that is why they're able to collect billions of shillings. Because these guys still look at the 100,000. 100,000 in a T-bill at 7% is not useful. I think it is better if I can make 250 with these guys. So let me give them 250. Let me even borrow now 2 million and give them. So we are very gullible in that sense, that we believe what we are told. We don't want to do the research. We don't want to spend the time. We don't have the patience.
And we don't want to do the work.
We don't want to do the work. So when you hear it'll double your money in 2, 3, 4 months.
And you do nothing. You're still going about your other business.
You then say, yeah, that's the one that I want.
Yeah.
Actually, that is the one that I should invest in. And you see, more often than not, it doesn't work.
No.
So it takes a long time to do these things, which is perhaps where we don't, that is perhaps not what we focus on, which to me is the wrong thing. So 10% relative to most countries on the planet is good. You need to know that. But first go and make some money.
So that's a hard truth, but it is the truth.
Right.
And you've put it so well. I couldn't have said it any better. But my mind quickly goes to those who earn about 100,000 shillings a month, employed, so perhaps they don't even have the time to go out and start a new business.
That's right.
Maybe they're not even interested. They're so passionate about what they do. They love what they do, but they earn 100,000, and yet they want to be, investing and be a millionaire and retire.
That's right. Yeah.
Comfortably.
Right.
Yeah. So what advice would you have for somebody like that?
Okay. I think that for someone who's earning 100,000 shillings a month, his number one or her number one priority should be financial security. So they need to be very careful and deliberate around what they do with their money. Most people in that situation, I know, have been there. I was even earning less. Most of us in that situation use all the money. So we are more or less living month on month or paycheck to paycheck. We don't somehow see that as a crisis. In fact, we see that as fine. Because surely, just the same way I was paid last month is the same way I'll be paid this month, and the same way I'll be paid the following month. So truly, I can afford to, go and buy a car and go to Mombasa twice a year on holiday. And I can also drink the same wine you're drinking. Why can't I take that wine? In fact, it's meant for people like me. People come up with all manner of arguments. Yeah. But it's financial security, because if you lose your job, as an example, you then go down to zero. You start afresh. In fact, it becomes a very heart-wrenching scenario because you have nothing to fall back on. So now it becomes friends and family and so on and so forth. So the number one priority for someone who's earning 100,000 shillings a month to me is financial security. So save some money. Make sure you have at least 2 or 3 or 4 months worth of salary saved up in cash. So make sure you have some, you're saving some 20 or 25,000 shillings a month.
That's about 25% of your salary.
That's right. In a year's time, that will be, I don't know, maybe 200,000 or 250,000. You do that again for another 6 months, you now have some 350, 400,000. Then you can say, if I lose this job, at least I can still pay my rent and do 1 or 2 things, isn't it? It's very important for one to be able to have that mindset. It's also a difficult thing to achieve, particularly in today's world when we are so heavy on consumerism and so on and so forth. I can also go and buy a new pair of shoes. Why can't I buy a new shirt?
I mean, I've worked so hard.
I've worked so hard. I mean, surely. So we are quite keen on consumption.
Yeah.
So one has to be very deliberate, and it's a difficult thing to do. It's difficult to sit at home as people are off going to do all manner of other things. So you've got to have an eye on the future. So I'd say at least for the first 18 months, surely save that money. Make sure you have something there. And if you do realize that you're working well, the company appears to be having prospects and all that, I don't think I'll be sacked tomorrow or the job will end tomorrow. Take that 400,000 and go and do something. Go and join some investment group. Go and sit down and work on that business idea you've always thought that you need to work on, and turn that 400,000 into 1 million, right? And if you think hard and long enough, particularly because the economy these days is so diversified, I think you can come up with something to do. There's always someone who needs something or some service or some need. So try and work on that. And I think if you do follow that kind of methodology, in 4 or 5 years, you'll have some 1 million. In fact, your colleagues will look at you and show, how did you get 1 million? You must have done, you must have been in a betting. You must have gone into a sports betting thing. You'll say, no, I was not in sports betting. Or you must have been in a pyramid scheme. No, I was not in a pyramid scheme. Or maybe your father gave you the money. No, actually, my father passed on 10 years ago. People will then wonder, how have you done all that? So that is what I would encourage somebody to do, so that if you lose the job, you have something to fall back on. But more importantly, you can better yourself. Now, for you who is earning the 100,000, just like I did, work hard. Get the promotion. Go from 100,000 to 150,000.
Yeah.
Then from 150, go to 210,000. And from 210,000, get a promotion, become a manager, earn some 350,000. And if you follow the same methodology, you will really do well. And maybe you started working when you're 25, but surely by the time you're 32, you should have made some progress in life. But it's not an easy thing to do, but it is doable. That's what people do. So if nobody has ever explained that to you, you need to hear it now, because that is exactly what then happens.
Yeah.
So whether you're on 100,000 or 50,000 or 1 million, the principle is the same.
It's the same.
That's what you need to do. That's what others do out there in the West. So why are we not doing that here? So that is, 100,000 is not what is going to stop you from doing those things. You do it even at that level. But I recognize it's easier said than done.
But it can be done.
I recognize we all want to go and buy a Subaru.
Yeah.
I recognize we all want to go and eat in a nice restaurant. Just plan for it. So 25% you save. You certainly need to pay your taxes. So guess what? Half your money now has gone, isn't it?
Yep.
So you need to then set aside money for your utilities, power, water, transport, rent, whatever it is. And then make sure there's something left for you. It may not be much, but it is better that way. Most people start the other way around. You have to pay taxes, you can't do away with that. They then pay themselves, and paying yourself is consumption.
Okay, that was actually, I thought that was actually paying others.
No.
That was paying Safaricom and paying Kenya Power and all these other guys.
First, most people start with themselves, meaning that on payday, there's a reason why all these songs are made about payday and so on and so forth. So on payday, you go and, you pay yourself in summary. So you go for drinks, you buy clothes, you go on holiday. You then kind of just make it in terms of utilities. So you never save.
Or you save like 2 Gs.
Yeah. And you then say, these 2 Gs in a T-bill is a waste of time. So you see, that is what then happens. Yeah. But you can make it. If you want to go on holiday twice a year, you just need to save. If you want to spend 100,000 in Mombasa, it's okay. Just save. Save your, 7 or 8K every month. You will go. And you'll be very happy. You'll actually have your 100,000 to do whatever it is that you want. But not, don't go and take then a bank loan
To start
to
going
get
on holiday.
100,000 to then, that is what is not going to work.
Yeah. That's a whole other topic.
Yeah, in itself. Yeah.
Yes.
Yeah.
So I guess I want to segue into this product that you have.
Right.
You've been running a campaign.
Right.
I saw it's called MdogoMdogo.
That's right.
If you could just sort of give me a sense of what's that all about, and how can people benefit from what you have to offer at the moment?
Yeah, we are an asset management company, and our work is to then, in summary, render or provide professional advice to our customers. Anybody can become a customer of Britam Asset Managers, any person on the street. And what we typically tell people is that as you go about your business of making money, because remember you need to go and make money from somewhere, we then can give you the right advice with respect to your investments. So we'll watch all those stocks for you, right? And give you and kind of invest in the good ones for you and help you avoid the bad ones. We will be able to facilitate your investments into the T-bills. So you don't have to worry, how do I access a T-bill? Where do I fill in the application form? Must I take it to the Central Bank of Kenya myself? So we will do all that for you. I want to invest in real estate, but I'm not sure where to start. We can assist you with all that as you go about your business of making money. Because remember, these are passive investments. So we do this for individuals, right from the bottom all the way to the top. By that I mean whether you have 1,000 bob or 1 billion, we'll work with you. And we do this as well for institutions, pension funds, companies, parastatals, and so on and so forth. So the campaign MdogoMdogo is around making investments more accessible to absolutely everybody, right from the common man on the street right up to the topmost individual. The backbone of the campaign is then premised on our new digital platform. So we have now rolled out a mobile application accessible on your phone and a customer portal that's accessible on a laptop or PC. So all you have to do is download the mobile application. It's free on the Google Play Store or the Apple App Store. And you can then go through the entire investment process. So you fill in your own documentation on the app in terms of name, ID, and so on. Submit your ID documents online. You can create your own account online. You can invest yourself, either from M-Pesa or from the bank or wherever it is. You can withdraw again from the application. You don't
need to send emails and fill out forms.
You can view your statements.
Wow.
You don't have to talk to anybody. You don't have to talk to anybody. You don't have to write any email. You don't have to send us any hard copy statement, which is good at this point. You can be in Nairobi or Lodwar or Mombasa. You can do it from absolutely anywhere. So truly, it's now power to the investor. So at any one point in time, you have that accessible to you. And our message is for as little as 1,000 shillings, which is why we call it MdogoMdogo, you can now access this investment. So if you're earning that 100,000 shillings a month that we were talking about before, you now have something to do with the money. Because for a lot of people, what do I do with the money? And that 1,000 bob will earn you 10% in terms of a return, which I think is great. Nobody will give you that kind of return.
Is it currently 10?
It's 10, yeah.
Yes, that's high.
Yeah, it's between 9 and 10%, which is great. So in my view, that is what should be happening. We are trying to get the message out and spread the word out that people need to obviously be more financially aware.
Yeah.
You also need to be able to take some actions to safeguard your financial security. And one of them is to consider these kinds of passive investments. I think they make a huge difference. They are not ultimately what is going to lift somebody from poverty, and I think we've discussed that. It's important to be able to do something with the money. But our message is rather than leave the money doing nothing in a bank account, think about investing it here, because in the bank account you earn 0 or 2% or whatever. Here you earn between 9 and 10. It is just as safe as the bank account and also just as accessible as well. But more importantly, take the active step to save and put some money aside. That I think is the most important thing. If someone can, out of all this entire engagement, take the decision to set some money aside every month, they'll be better off than having done nothing.
Yeah.
So we want to obviously promote ourselves because that is what we think we are as a responsible party, a responsible financial intermediary, and a responsible provider of financial and professional advice. So I think talk to us or talk to anybody who you feel that you trust, because it is important to be able to take those decisions early. The later on you wait in life, the more complicated it actually becomes.
It's true.
You'd rather start when you're 20 and 30 rather than start when you're 50. But even if you're 50, you should still start, because it's better than not having started at all. And obviously with advances in technology, we will all live to the ripe old age of 80 or 90. And I think that's what a lot of young people forget, me included. One day you may be 70 or 80.
Yeah.
And if you're very lucky, even 90. Remember, you've gone from 0 to 40 years. You now have another 40 to 80 years. So you need to take advantage of your productive years to do something, because you'll really benefit from that, in your older age. And it doesn't seem that way, but even you who's 30, one day you will be 80. You have to get there.
Yeah.
Because those people who are 80, they were once
20.
20 or 30, and many of them still have the same mentality. I'm still a young person, but the body is saying something else. Yeah.
This is really useful stuff. This is awesome. I'm so grateful to have had this opportunity.
Sure, thank you.
You know, I remember the RBA CEO in 2017 saying that this is getting alarming.
Right.
80% of Kenyans are retiring poor.
That's right.
Unable to sustain their basic life needs.
That's right. Yeah.
So this is really, really helpful, and I hope people will take this, seriously and start wherever it is that they are.
Yeah.
So I want us to bring this to a close. And, what would you say as we wrap up? What's the one thing you want to, sort of say to close this up?
Yeah. I think the one thing I'd want to also share is a similar statistic that I got from an RBA forum, Retirement Benefits Authority forum. They are our pensions regulator in Kenya. And what I got from the forum was that the size of the pensions industry is 1.4 trillion shillings. It's a lot of money, 1.4 trillion in retirement savings. But I think it was 70% of all that money is with people who have balances of less than 1 million shillings.
70%?
Yes.
Wow.
Have balances of less than 1 million shillings. So you see, the number is big. But you dig deep into it, people are retiring on 1 million bob and below.
Imagine.
So you've got to ask yourself, is that good?
No.
Is that even the way it's supposed to work?
That will run out in a year.
Less. So imagine you've done your 30 years in a career, 70% of you have less than a million. Is that even the way it's supposed to work?
That's so sad.
So can you please make sure you're not one of them? So set some money aside. Start to save, start to invest, do something to actually generate some money, so that as you retire, you're not left with that. You're not one of those 70%. And 70% is a big number. If you go to any room and count 70% of the people, it is almost everybody. So be those ones who are different, and make sure even if you're earning 100,000, you are not caught up in that. Because even if you earn 100,000 for 30 years, you can still do much more than that million. But if you are not taking some of these concepts to heart, then it can become a very, let me call it, story which is not good, potentially as someone retires. So I want to thank you for the opportunity then to engage and to speak. I think it's been very, very useful. I think it's been a great 1 or 1.5 hours that we've spent, and I think if we can do more of this kind of thing and get the message out, then I think we will all be the better for it. So thank you very much.